Hello, Internet friend. Today on Value Side, why opening the Hormuz Strait may not lower inflation. I'm David Ravel. Well, consistently, the American people have responded in nearly every opinion poll that their most significant concern is affordability, that steadily increasing costs of necessity. It's followed by their concern for future economic growth and the prosperity that would bring. Now, last week, President Donald Trump met with Chinese leader Xi Jinping, and as you know, China is our most important trading partner, the single country most responsible for those twin goals of low inflation and affordability. It would seem natural then that these two leaders would spend a substantial amount of their time seeking ways to enhance their mutual trade and cooperation. Unfortunately, the two leaders met for only 2 hours. Hardly enough time to work out the kind of agreement needed to put the Sino-American relationship back on track. Indeed, it appeared that Premier Xi's main concern was to make clear to the United States that it must not interfere in Taiwan's internal affairs. At the same time, President Trump was most concerned about securing China's help in opening the Strait of Hormuz and ending the conflict with China's ally, Iran. Indeed, while the White House did not indicate any substantive move by China to curtail hostilities in the Middle East, President Trump suggested that deals were made that provided that Boeing would sell commercial jets and jet engines, and that American farmers would sell agricultural products to China. It would be consistent with how Trump assembles his team, a team that was short on diplomats, but long on American business executives, anxious to put together the aforementioned deal. In the meantime, the American public continues to be plagued by steadily increasing prices. The Bureau of Labor Statistics, which keeps track of these things, reported that its core inflation rate surged to 3.8%, catching Wall Street analysts by surprise, who had projected an increase of just 0.1% to a much lower 3.7%. The demon in this equation was the steadily increasing cost of energy, which rose by 2 points from last month, now reaching nearly an 18% increase on the year. Hence Trump's reported entreaty to have Xi talk to the Iranians. However, an issue remained unanswered: the lifting of China's embargo on rare earth minerals. It is a vital issue for U.S. strategic interests. As our readers know, the country is running perilously low on high-tech munitions needed both to support Ukraine and combat Iran, as well as provide for our own strategic stockpiles. Many of those munitions, such as the Patriot anti-missile anti-aircraft system and the F-35 fighter jet, require rare earths in their production. It's a long story, but over the years, China has gained a near monopoly over the production of these rare earth minerals. Interestingly, it gained the refinement technology from the U.S. Now, any U.S. president faced with the looming possibility that we might lose critical defensive capabilities would, at a minimum, have discussed renewing China's supply of these vital rare earth minerals. It's an open question whether Trump and Xi did indeed discuss this issue at their summit. The mere fact that neither Beijing nor Washington is touting a new trade agreement or a new rare earths agreement suggests that no agreement was reached. Instead, the president likely came away with a couple of commercial deals that will do either little or nothing to mitigate Americans' concern over inflation or to provide for our nation's strategic defense. Let's take a look at prices. So on Tuesday came the report that the most widely watched measure of inflation, the Consumer Price Index, rose by 3.8% in April, accelerating by 0.5% over March, the highest claim in inflation in 3.5 years. What makes this particularly significant is that this measure of inflation on which most COLA, cost of living adjustments, are based. It's when these circumstances begin that economists fear a vicious cycle of higher prices leading to COLA adjustments, which in turn lead to higher prices, and so on it goes. Economists weren't the only ones looking at their spreadsheets and seeing red. In downtown Manhattan, the world's largest financial market began to shudder. The U.S. Treasuries started to price in rising inflation, and the numbers don't look good. The most widely followed Treasury, the U.S. 10-year note, saw its yield rise to 4.59%, the highest level in years. Now, the 10-year note is the security upon which most adjustable rate mortgages are priced. A rising price for the 10-year will mean higher mortgage payments for many. Yet another part of the vicious cycle: rising prices, rising costs. Americans' concern about affordability continue to worsen. Now, what we're seeing is the same phenomena that we experienced in the 1970s. The cause for both is rising energy prices. In both cases, a severe limit on the amount of oil coming out of the Middle East. In the 70s, the OPEC Oil Embargo, and today, the Iran conflict. However, it's what's happening next that is critically important. Rising prices rarely remain in the energy sector. As we've seen, energy inflation quickly infects the financial sector also. And it is this derivative inflation that was so incredibly difficult to control 50 years ago. When the contagion of higher prices rolled through the economy, it was nearly impossible to stop. Back then, President Nixon tried everything from wage and price controls, tax cuts, and even a stringent monetary policy, but nothing seemed to work. Eventually, it came to the Federal Reserve under Chairman Paul Volcker to raise short-term interest rates to historic levels. The Fed funds rate rose to over 19%. It's less than 4% today, in the summer of 1981. The result was predictable: a destruction of economic activity, but also a destruction of inflation. Are we looking at the same sort of draconian rate policies today? No, I don't think so. We're nowhere near the lengthy inflation problem that we faced back then, but we've headed down that road. We've unleashed the same sort of price problems as we had in the 70s. Making matters worse, we're seeing the energy price contagion now infect the financial system. Note that bond market this week. Inflation momentum is building, and opening the Hormuz Strait alone will not curb this bout of inflation. If the 70s taught us one thing, it is that second-level and third-level derivatives persist long after the initial cause for inflation is gone. The OPEC oil embargo lasted for only 6 months, from October 73 until March of 1974. Yet here was Volcker and the Fed fighting, ultimately winning, the inflation battle in June of 1981, 7 full years after OPEC restored its oil supplies. Unfortunately, today's war of choice with Iran has unleashed financial forces that likely will take months, or possibly longer, to rectify. Let's look at producer prices. This week, the Bureau of Labor Statistics reported the same sort of secondary impact from the rise of energy prices, this time in the production sector of the economy, as we saw in the financial sector. Producer prices, those wholesale costs incurred by the companies that make things, rose by 1.4% for April, the largest rise in over 4 years. Now, as consumers, we can look at this as a glimpse of the future. That is, the companies that are now making the goods and products that we will purchase in a few months are experiencing higher costs now. Those higher costs will be passed along to us as the products are completed and reach our store shelves. Another indication of just how difficult the inflation contagion can be once it begins. And that's today's Value Side. For all of our articles and podcasts, visit valueside.com. I'm David Ravel. Value Side is independently written and researched. The views expressed are strictly my own.